Hi, my name is Eric Weiner, and I want to thank you for trusting in me for your financial plan and ESP Financial for your financial planning purposes. I do want to remind you that this is a living document, so as we get this finished up, this is a document that's intended to be um, addressed on an annual basis. Your needs are going to change, the circumstances are going to change. So we are going to be looking at making some changes with this, and I'm looking forward to that professional relationship with you. So I have provided a full detailed document for you. It's going to have a little bit more details than what we're going to talk about here today. Today is going to be a very quick touch just on the basics for this plan. So all of your plan documents are going to have a little bit more detail than what we're talking about here. When we first look at it, the first section that I would like to address is going to be insurance. So life insurance is going to be one of the first aspects that really definitely jumps out at us. Robert, you do have some decent coverage based on what we're seeing with it and expectations of what we have coming up. But the issue that we're having is going to be the beneficiaries. So right now, both of your sons are listed as the beneficiaries, and one of your highest concerns was making sure that you're providing for Lisa as well here too. So definitely an opportunity to be able to make things a little bit better here, possibly into a trust situation or changing Lisa to the beneficiary. So a couple things that we need to talk about on insurance to get you where you need to be. Lisa, you don't have any insurance at all right now. I would recommend that we get into some insurance there and to be able to get you at least your overall liabilities covered with your insurance, and then your funeral expenses with that. That's going to help protect Robert, and then also provide for good inheritance for your niece as you were looking for her being your beneficiary on everything, to make sure that your expenses are covered and that she's still provided for there as well too. So we do have the personal liability policy. I think we're in good position with that. I think no changes there. We may look at backing that off a little bit later on. Health insurance is going to be provided through Robert's company. Great opportunity. His company is going to cover for us up until the Medicare ages. It does look like we have reasonable deductibles, reasonable coverage. What we are missing out there is going to be dental and vision. So we can work with you on providing a dental and vision plan as well too, to make sure that you have full coverage there. The disability, I don't think is something that we're going to be needing for you at this time, as we're going to be looking at a fixed income. Auto insurance, we do have good coverage, good deductibles on everything with that. One thing that I do see there that is definitely a weakness, and this is going to be the fact that you don't have any uninsured motorist. Also, with the value of your vehicles, I would highly recommend an underinsured motorist to make sure that the value of those assets are fully covered for you. The homeowner's insurance, you asked a specific question about the kitchen fire, so that is addressed within the full financial plan that I've provided. There is an immediate concern with both the residential and the vacation home. Neither one of them are going to be covered with full replacement value, so I do think that is an immediate concern. Even with the aspect that we're looking at selling the property sooner than later, I would look at making sure that we do have full coverage on this. If we've prepaid those premiums, any premiums not being used are generally going to be refunded back to us as an overpayment. But we definitely need to make sure that all of our coverage is going to be up to date there, and we have full replacement value with that. For the emergency fund, I have taken a look at everything. The $60,000 that you're talking about, I do feel is going to be adequate, especially when we're looking at fixed income. We know where it's going to be coming from, and at $15,000 a month, we're going to run at 45 plus Social Security. So I think 60,000 is a good place to be. With the residences, if we look at a current sale of your principal residence, then we're looking at some taxable income, because Lisa's had a qualified 121 sale 18 months ago. So my recommendation for you on the sale of the residence is actually look at waiting till June, qualifying for that Section 121 exclusion. That's actually going to provide us with approximately $26,400 worth of tax savings by waiting for that qualified exclusion with that. Going to give you a little bit more money for investing. Right now your job is stable to be able to cover the expenses of that house up until that time. So I think that's actually a good position. If we can work through May and then look at selling that property in June, I think that brings us to right where we're looking at for what you were requesting with your retirement. As far as the vacation home, we do have options. I don't like the gifting option at this point, because we are looking at an adjusted basis that is that's higher than fair market value, which is going to reduce that taxable gift. If we're going to look at keeping the property, I would recommend more onto a trust aspect with this and hoping that the property may gain some value up to that time. But I actually think we're in a better position, since we're not qualified for Section 121 on this property, to actually go ahead and make that sale here and to be able to use some of those gains to offset some of the gains that are coming from that installment sale. Lisa, you asked me to take a look at your portfolio, and I do have all of the questions that you asked in reference to your portfolio in your detailed. So if you take a look at that, let me know about any questions that you do have on that. I think we're a little bit aggressive stock heavy there. I think our risk tolerance is a little bit higher than what you described, and you have to remember, the older we get and the more stable our income, or more set our income becomes, the more moderate that we're going to want to be with our investment. So a couple aspects to take a look and talk about in there a little bit more. As far as the business, first of all, Lisa, congratulations. Wonderful opportunity for the position on the company with this. The installment sale, a great opportunity to help spread this liability. Actually going to be looking at keeping this out of the net investment taxes and potentially AMT based on the rules that we have currently. It looks like we're going to be in good shape with that. I'm just going to provide for the regular income for 10 years. We're going to talk about that in a little bit. We've looked at the gross profit percentage. It's going to run at 75%. So out of the sale price, 75% of it's going to come in as long-term capital gains. The remainder of that's going to come in as recapture of basis for that non-taxable. The interest on the sale is going to come in as ordinary income on your regular tax bracket. Based on the 9% interest rate, we are looking at $416,000, a little over the 10-year period. So one thing that you may want to consider here is an early termination clause to help protect the earning advantage on this aspect for investment purposes. With the retirement plans, we do have the defined benefit pension plan with the single, joint, and lump sum options. The single and joint are both going to provide about $1.5 million over the lifetime, but we're talking 20 versus 30 years. A little bit safer for the joint for Lisa on that. But if we take the lump sum with some assumptions that we have made, investing on your own is actually going to provide a little bit more at $1,581,480 over 30 years estimated, which is going to give us a standard payment of $43.93 a month. The issue with that is it is going to bring the investment risk onto you. So something that we do want to talk about a little bit more there. The SPDA annuitized, I think, is going to be the better option here. We're going to recapture that at 19.86% tax-free, which is his basis in that. So that'll be recaptured over the lifetime with it on a per payment. If we take the immediate lump sum, we are looking at recovering all of that basis in the current year, but we are looking at a substantial add to our taxable income for that year. And I don't think that's going to be a preferential position for us to be in. We do have the IRAs, the traditional and the Roth. The traditional is going to come in at taxable income at the point that we start bringing that in. RMDs are set to begin in June of 2025. No RMDs on the Roth. We are in a qualified distribution position for the Roth IRA. And Lisa, your options for the IRA, should he pass, I do have those detailed out in the defined portfolio that I provided for you. Social Security, we have run the calculations. Robert, you're at 66. Lisa, you're at 67 for those ages. The percentages and everything else that you've asked for are in the detailed portfolio we've put out there for you. As far as estate planning, I would recommend a revocable living trust here. It is one of the most popular being used today. It's going to avoid probate. It's going to provide care for Lisa. It's going to the successor trustee. It's going to help. We can leverage the expertise of a third party with this, and we're going to be able to set the beneficiary, which is what you're looking for. So I think some legal advice on a living trust is a really good opportunity for you guys right now. The other aspect for the legal advice is I would look at your wills are out of date, but are they needed if we have the revocable living trust? I'd also take a look at the power of attorney, durable power of attorney, and living wills, just to make sure that we're in a good position with that. But again, we're going to need legal counsel to be able to take a look at all of the actuals with that. So the meat and potatoes of it is you're asked if you're going to be able to retire with $15,000 a month in the immediate future. And I believe that we can. With the sale of the principal residence, sale of the vacation home, lump sum option on defined benefit, and annuitizing the SPDA, we're looking at everything. I'm looking at payments actually at $18,393 in the first 10 years. We're going to look at investing the additional money, and with the additional money invested at the point that the other payments drop off in 10 years, our investment that we're going to have with some basic assumptions at that point is actually going to cover the remaining amount that we're going to need to cover the $15,000. And per my calculations right now, actually just a little bit over as well too. So it actually puts us in a very good position. And then additional money invested in non-qualified would help provide for step up and basis for inheritance purposes. So I think we're in a good position. I'm looking at approximately May, depending on a couple different options, and I think we can get there. So I want to thank you for trusting me with your financial planning, and thank you for your time.